Change of guard and the market impact. Well, more than change of guard, I guess markets would be happy and delighted to really understand that from Reserve Bank of India, the message from the government is that rather than change, it is continuity. Dr. Urjit Patel will be the new boss of Reserve Bank of India. He has been the deputy governor, or he's currently the deputy governor of Reserve Bank of India, and from a market standpoint, what really matters is that the suspense is over and there would be continuity. Yes, some bond market believers or some bond market watchers are of the view that Dr. Urjit Patel could be slightly hawkish given his views on macro policy and given his view on targeting inflation. So let's understand the market impact of the change of guard at Reserve Bank of India, and over the next 30 minutes we'll debate all the nuances of how should one read the current change of guard. And to do that, I've got three very special guests: Navneet Munot, SBI Mutual Funds; Ajay Bagga, and to give us a better understanding of the bond market, I've got Ananth Narayan, co-head wholesale market with Standard Chartered Bank. Gentlemen, good afternoon to all three of you. Sincere apologies, it's a Sunday afternoon and we've really troubled you out of your movies and your lunches, so really appreciate you've taken time out. Ajay, we are calling the headline title of the show Change of Guard, but more than change of guard, the message from the government is that this is only continuity.
Yeah, definitely. And you do a contrast with 2013 when Mr. Rajan came in. Rupee was tanking, inflation was 10% plus. India was a really no-go zone. And Rajan was declared in the middle of the business day, I remember, Nikunj, and there was a lot of market reaction to that. This is a low-key appointment on a Saturday afternoon, a very terse appointment. So it goes with the individuality of Dr. Patel also to that extent. Government has really chosen merit and continuity over any other factors. He is the author of the report which is really guiding RBI these days. So I think it's a good vote for continuity and markets will treat it quite positively.
Ananth, we are using the word continuity, but that also means that the new governor now will be relying on traditional tools which Reserve Bank of India has used to target inflation. And when I say traditional tools, the traditional tools by and large are always called as the hawkish tools, which is that you don't cut interest rates.
Good afternoon, Nikunj. First of all, as you said and as Ajay said, I think it's a bit of a relief that we have the suspense and speculation out of the way. Otherwise, every single day we were starting with a new name and the market was kind of unstable. So good to have continuity, good to have certainty, and we can move forward. On the continuity aspect, look, you mentioned traditional tools. It's not that traditional, to be honest. The entire new monetary policy framework that we've just set up is only the result of the eponymous Dr. Urjit Patel committee report, which was late 2013. So it's fairly recent, the move from WPI to CPI, and the fact that it's now enshrined both by the government and by the RBI. So to that extent, it is still nascent and there's still some debate, or was some debate around it. What this, declaring Dr. Patel as the governor does is it takes away any element of, doubt about what goes on in the future. The path is very clear. It's as it's been set out as inflation targeting or flexible inflation targeting. To that extent, it will come as a huge sigh of relief, particularly for overseas investors who really like this whole approach of inflation targeting. So I think it's continuity in the right form. And after all, monetary policy is arguably the most critical part of the RBI's job description. So at least in that critical aspect, there is continuity, which is, I think, good for, especially for overseas sentiment.
Ajay, let me put it this way. The framework at Reserve Bank of India is set. It's watertight. And frankly, individuals don't matter because the idea really is that your framework is given and you have to follow and just fill in the colors there.
Yeah, see, to a large extent, RBI is a cadre-based organization. People do full careers at RBI. And the monetary policy is a collegial decision-making. But what we were seeing a lot of the minutes that were coming out, there would be a consensus for a rate cut, but Dr. Rajan was overruling. Now that fundamentally is going to change, Nikunj, with the 6-member Monetary Policy Committee coming in. Of course, the RBI governor can break the tie with a casting vote, 3 votes to RBI, 3 votes to the government nominees, still to be appointed committee. But I think the role of the RBI governor is becoming even more collegial. Having said that, there is going to be continuity because there is a huge, cadre-based organization which really runs the country's debt management, monetary policy, as well as the FX management and the management of banks supervision. So that continuity is assured. What the governor really brings in, one is for the international investors, what Ananth was saying. So I think both rating agencies and FPIs will welcome this move. That will bring a thumbs up to the markets. Hopefully there is continuity because he was in charge of the monetary policy. And what has really moved the yield downwards, Nikunj, in the last 3 months has really been the liquidity injection. We were starved for liquidity, so the entire move of the 10-year and the yield curve has been more because liquidity has been made more abundant by RBI. And if that policy continues, hopefully the bond market reaction, which we are expecting tomorrow morning, will be short-lived and we'll be at stable rates by the end of the week.
So I'll talk about that bond market reaction, Ajay, which you mentioned, but let me also bring on board Navneet Munot. Navneet, first let's talk about the equity market reaction. Dr. Patel's name was already doing the rounds. Media, including ET Now, we've been talking about that. There was something, there was some serious thinking which was backing him. So, do you think, from a market standpoint, this is more like a no news, or there could be a change in perception?
Not really. I think those who were thinking that we can get an instant gratification by a little more rate cuts and that can prop up the asset prices in short run, I think fail to understand that for a long-term structural bull market, one of the most important thing is macroeconomic stability over the years, which comes from a sound and prudent fiscal policy, a good monetary policy framework, a sound banking system, so on and so forth. So I think that's far more critical for a sustainable long-term bull market than maybe 1 or 2 rate cuts which can come early. So from that perspective, I think this is a good news that we've got Dr. Patel, who drafted the monetary policy framework, who drafted the inflation targeting policy, making the CPI as an anchor for the monetary policy, the whole formation of the monetary policy committee, so on and so forth. So from that perspective, I think those who invest in India from a longer term perspective, this is a good news.
Ananth, do you expect a reaction in bond market tomorrow morning at all?
There will be, Nikunj. So look, it's possible that some of the market participants were expecting a change of guard to signal a change in the policy framework as well, i.e., as Navneet was saying, instant gratification in the form of fresh rate cuts, etc. So to that extent, that slightly unreasonable expectation was built in. We will see a correction and we will see yields, some of the rally which happened the last few days taken back. But frankly, I don't expect a reaction of more than, let's say, 3 to 5 basis points. Thereafter, and the other thing which is probably going to keep markets nervous is the last CPI print was above that red line of 6%. And with a monetary policy framework now in place, it's always a question mark as to how the RBI would react in the short to medium run if you do see spikes of this nature coming through. But I think the market will eventually settle down for a couple of reasons. One is, look, in the medium to long run, if you have a clear direction towards a glide path of 4% CPI, and if real interest rates can't be more than 2%, frankly, overall yields need to move to a floor of about 6% or so from where we are currently. So to that extent, this is actually quite bullish for the medium to long run if you have a very clear inflation target in place. The second thing is, while you have an ephemeral 6% print on the CPI, we know that is kind of temporary. We are seeing vegetable prices and pulses prices and therefore overall food prices coming down. We do expect the next few prints to be quite favorable. Of course, it's very difficult to chart the future trajectory of CPI, but expectation is they will head southwards and therefore give eventual room for the monetary policy framework to play out. There will be other things the bond market will look out for over the next short to medium run. Let's not forget we have the large FCNRB repayment coming up in between September and December. And at that point of time, I think the RBI's resolve on particularly the liquidity framework will be tested. As Ajay was saying, a large part of the bond rally has also been because of the change in the liquidity framework this year, much more than the rate cuts. Now, that would be a good time to actually figure out what the new governor's thought process on the liquidity framework is. And I guess the bond markets will wait to watch that as well.
I guess that would be the real first test for the governor, that how exactly we deal with that entire FCNR redemption. Ajay, let me just change the complexion of the debate. Now, what Dr. Rajan brought on table was a lot of global experience, his understanding of global markets. He was the first one who really called out the financial crisis bubble. He was the first one who went on record and said, look guys, watch out, there is a bubble in making in the US financial markets. Now, that's a lot of global experience, and that is what he used in 2013 when we had to suffer, or we had the taper tantrum issue. With Dr. Patel, do you think that could be the missing link?
I think you won't have a rock star. He's a doer. I was talking to some State Bank of India senior people last evening, some old colleagues, and they were talking of how on the board he's very realistic and he's a doer. He doesn't like the limelight that much. So as against a rock star who was on an international celebrity, Dr. Rajan, you have Dr. Patel, who's a doer, who's more unassuming and more quiet personality. But foreign investors, Nikunj, what they would like, what Ananth was also mentioning, that the continuity with the MPC framework in place, and the government has just passed the next 5 years inflation target and allowed a 4% target going ahead. So I think those are very good feelers that the government has done. I think they have timed it very well, is what I would say. They ensured that they passed the inflation target. So they are also showing by action that we are committed to this inflation targeting, and then they bring in somebody who's very solid academically and has a huge institutional experience, 4 years experience within the RBI running the monetary policy. I think that counts for a lot. Rajan came out of academia and from the Prime Minister's Economic Council, which is more macro, which is not as much monetary policy per se, but he had great credentials. One thing I would really watch out for, that Mr. Subbarao was extremely very generous to Rajan. I remember the FCNR days, and he allowed Rajan to address the press conference even though he was the designate and taking over 3 days later. I hope now Rajan cools off his bashing of the government in speeches and allows Dr. Patel to come in quietly and take over, because FCNRs remain a huge issue with 20 billion having to be repaid. Most of that will go out because that was leverage money coming in at a premium. And today you are not offering that 3% return or 10% dollar return on the leverage money. Most of that will go out of the country. It needs to be handled quietly and without making too much fuss. I hope that is followed in the next 15 days.
I always say this, that when markets know that event or trigger is coming, they tend to discount it, or they tend to really adjust. And in this case, I'll just get a sense that looking at our forex reserves, liquidity, the fact that flows have been benign, money is naturally migrating to our markets like India in this low yield environment or low yield global environment. Maybe FCNR could be challenging. It could have an impact. That really could be an adjustment impact, but I don't think that could be a problem. But moving on, Navneet Munot, this question is coming your way. So, in your understanding, do you think all the Reserve Bank of India measures will continue, especially when it comes to inflation targeting? Because now the new governor himself, we know the thought process of Dr. Patel when he was the deputy governor, and now, surely and completely, he will be targeting inflation. Yes, Navneet. Navneet, the question was for you.
I think for a variety of reasons which may govern the direction of bond yields apart from the new governor, my personal view is that globally we have seen the bond yields, I think, bottoming out at current levels. I don't see bond yields falling further into the negative territory compared to where they are. I don't see monetary policy continuing the way it has been globally. I think with the oil inching up, with the impact of the 7th pay commission, and then in 2018 little bit from GST also, projecting a CPI below 5% is difficult. With all those factors in mind, and also I think the credit growth is likely to pick up from the busy season onwards. I think with all those factors, I think bond yields may inch up a little bit, but structurally I think if over a period of time RBI is able to achieve the inflation target of 4% plus minus 2% from 2017 or 18 onwards, that augur well for the bond yields in the long run. But in the short run, yes, we have seen a good rally, and maybe I think consolidation to a little bit of hardening is likely to happen.
Ananth, the challenge for the Indian banking system currently is that there is very little transmission of interest rate cut. What do you think the new governor could do to ensure that banks actually don't sit on their hands and they don't focus on their NIMs and they actually transmit the rate cut?
Nikunj, you asked a billion-dollar question. Look, while on the monetary policy framework, there is continuity and clarity, and we pretty much know what to expect from Dr. Patel, given he's the author of the report. On areas outside of the monetary policy, I guess we'll have to wait and watch and see what the new governor's views are. And this includes what you mentioned about transmission. It also goes into areas like financial stability, the health of the banking system, the overall market development and new products and so on and so forth. Specific to transmission, Dr. Rajan mentioned this as well. Clearly, they are relooking at the entire MCLR structure that they've put in place since April of this year. The reality is, to a large extent, the earlier fear that I guess industry or some sections of households had, which was that banks were bringing down deposit rates but were very, very tardy in bringing down lending rates, that has been addressed by the MCLR regime to the extent that our lending rates are now clearly linked to where our deposit rates are. And so therefore, the probability or the possibility for us to do one but not the other has gone away. But as you mentioned, there is a lot of debate ongoing about the transmission. Clearly, liquidity coming into the system has brought down market yields a lot, whether it's government bond yields, CPs, NCDs, etc. Unfortunately, a concatenation of events, including the upcoming FCNRB repayment and the busy season, plus of course the new LCR regime from 1st of January, etc., has meant that deposit rates coming down has been very, very sluggish compared to what's happening on the market yields. So there is various things possible. One of the things I guess that's being envisaged is whether lending rates can eventually be linked to some kind of market benchmarks, which I think would be the ultimate way of ensuring transmission. Just as globally you have something like a LIBOR and lending rates are linked to a LIBOR. So when you have monetary policy action, LIBOR changes and therefore lending rates automatically change. We need something eventually like that in the Indian context. The tricky part, of course, is getting that common benchmark which applies both to the financial sector and to the end user sector is very tricky. There are some candidates, but none of them are perfect. There could be bond yields, there could be CP/CD yields. I think we will eventually get there. We'll agree on some benchmarks to use. Maybe the FBIL can be useful there as well. And that might allow the next stage of reform of not just transmission, but also building up of a good yield curve, allowing corporate bond, long tenor repos, and so on and so forth. So we'll have to watch the space though on what active role the RBI plays under the new governor. We'll have to see what his views are outside of the monetary policy framework.
Well, we've discussed the impact we've really discussed that how equity markets, bond markets and currency markets are likely to open tomorrow morning. Let's take a quick break. When we come back, we'll talk about the other big problem, bad loans and the mess in the banking sector, and what Dr. Patel could do differently and what is the elbow room available for him to really make a difference. Right now, let's take a quick break. When we come back, we'll talk about NPAs in the banking sector, which currently are plaguing the entire system. Change of guard, the market impact, and we are debating, dissecting and trying to really understand the change of guard and how this will change your life, my life, our life and the economy's life. But as promised before the break, the issue which I want to touch base with our experts is the entire mess in the banking sector. Enough and more has been done in last 24 months, but a lot of good work still needs to be done before we can safely say that the Indian banking system has revived and decent banks have survived. And Ajay, what can Dr. Patel do differently? We are discussing about interest rates, inflation. It's very popular. It is very obvious to understand the Reserve Bank of India and the new governor and the connection and correlation with interest rates. But that's a small aspect. The other aspect is the banking mess.
Yeah, I think three things which he'll probably do. One, he will not allow the government to dip into the RBI surplus to capitalize. He was one of the big voices which opposed this move when it came up last time. Second, he should continue the NPA cleanup. At least the declaration has been more or less done. Hopefully now the space of NPA formation reduces. And third, you have to keep the pressure up on the government to keep its bargain on the fiscal side while recapitalizing the banks. And lastly, I think holding the torch to the bank managements, allowing them to go after the big promoters, I think that was the big thing that Rajan really brought in, and that should continue. And lastly, treating all accounts the same. We still have the issue, Nikunj, where an account might be an NPA on one bank's books and it is still standard on another. While in foreign banks, what we used to have is that if somebody had 800,000 crores with us, if on a 50 lakh loan they were short on interest rate, on interest payment, we would declare the entire 1,000 crore as an NPA. You had no, kind of flexibility. I think that is one thing that needs to be brought in. Rest, it will take time. It will need the economic cycle to turn around. Government doesn't have the money. You need 200,000 crores at least to recapitalize fully going into 2018-19. It's going to be an economic cycle view. It won't be an RBI run view, but at least we can bring transparency and engender more confidence into the bank balance sheets.
Ananth, the next billion-dollar question from me perhaps would be about the mess in the banking sector. Do you think Dr. Patel can take the legacy forward? Let's be real here. The banking system is still in a mess. Nobody has the balance sheet or the size or the scale to really recapitalize all the banks right now. Economy is yet to recover and the private sector or capex is still in a doldrum.
Yeah, Nikunj, I think it's more than $1 billion question, to be honest. Look, I think the first question, particularly with the change of guard at the RBI, we know that Dr. Rajan was passionately following up on the cleanup of, as you call it, the banking mess. He wanted it to come out into the fore. He wanted the banks to make a clean breast of their balance sheets and their P&L statements and their capital statements, and then move on from there. The first question would be, would Dr. Patel be as passionate as Dr. Rajan clearly was in pursuing this issue as publicly as Dr. Rajan did? I think that's something to watch out for. But let's face it, I think the solution is not necessarily in the RBI's hands. The solution, frankly, some of it is already coming through with the economy recovering, with some green shoots coming through, with the monsoon looking better than the last year, GST hopefully coming up the next year. That should give us some runway along with government investments into infrastructure for GDP growth to resume and therefore some of the issues to get swept away. But there's still work clearly to be done. I think there's still two areas that we need to focus on. One is getting a full handle on what is the whole of capital amongst banking balance sheets. That there are various elements to it. One is provisioning is still not adequate. All full disclosures may not have been made as yet. So both these put together is just a status quo situation of how much capital hold there is. Plus, let's not forget, Basel III requires that fresh capital injection has to happen under things like capital conservation buffer and DSIB and so on and so forth, which again is going to be an enormous amount of capital ask. Dimensioning what that total number is, because everybody agrees the 70,000 crores that the government has set aside may not be adequate. Dimensioning what is the actual size of the whole required is one issue. The second issue is finding out solutions around it. While a recovering economy will provide some solutions, that might not be enough, and we might require some other ways of actually resolving this. And there are various solutions which have been touted. One is, of course, interest rates coming down will definitely help. compared to the last March results, banks will show a tremendous amount of treasury profits, which should help buffet some of the losses. But that's again not going to be adequate. Where do we get the rest of the capital from? Do we have to rely on the government, or is there other ways of maybe starting a bad bank or something which can resolve this? There, I think Dr. Patel, even if he doesn't say things overtly, behind the scenes would have a lot of say with the government, given his stature as the RBI governor. But finding solutions to the problem and moving on and helping the engine of growth and the investment cycle in the country, that I think is the bigger problem. Hopefully, Dr. Patel will play a key role there.
Navneet, let me get closing comments from you. What is your view on banks? Banks, at least PSU banks, one would argue that they are still a hope trade.
So overall, cyclically, the things are likely to improve. My sense is that we are likely to see a credit growth picking up over the next few quarters. Large part of the recognition of the NPAs, I think, has happened. Maybe still there could be some issues pertaining to few sectors, few businesses, but we have to wait and watch on the whole resolution process that I mentioned, the actual recovery, how it takes shape, that we have to wait and watch. The private banks and the lenders, the retail lenders, particularly from the NBFC space, have done phenomenally well in terms of growth. I think that aspect is likely to continue. Even in the PSU banks result, as you mentioned about SBI, the retail lending of SBI has grown at 20%, so that segment has been doing well.
All right, gentlemen, we'll leave it there. So our panel clearly seems to be endorsing the fact that this change of guard is more like continuity. The bond market, the equity market, or the currency market, they will react tomorrow morning, but that reaction would be short-lived. The vote is for continuity. And as a channel, our view always has been that Reserve Bank of India is more like an institutional framework. The framework has been put in place. Individuals and personalities do matter, but the guiding principles are clearly in place. Now, when it comes to Dr. Patel, yes, the comfort factor here would be that the glide path on inflation is clearly well defined and he's likely to stick to that. His first test would be how will he deal with the entire FCNR redemption issue, and then more than rate cut, more than a word on liquidity, how he really takes Dr. Rajan's legacy forward in terms of cleaning up the banking mess. It may not show up tomorrow, it may not show up in the next credit policy, but that's where we are headed, and I guess that is the need of the hour. Gentlemen, once again, appreciate your time. Thank you for spending your Sunday afternoon with us. That's it on this special show. Thank you for tuning in, and thank you for watching ET Now.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.